Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so again, Steve, I don't know if you want to comment on any of that before we get into move further. If you have any comments, always welcome.
I guess the only comment I would have is that option premiums are based on the market aggregation of how volatile everyone thinks the market's going to be. Jason's going to talk about that, but Just think of it this way: is that if you change your mind, you can always change your mind, but nowadays I'm getting questions very often. As I said, I was just out in California, many people saying, well, why not just buy calls and puts and wait for, one side to be right? I think Jason's going to get into that, the idea that, you really, you end up paying for hopefully what you're going to get. Sometimes you may think that the market's going to move a lot. If it doesn't move a lot, you could be hurt by that. And again, if you buy low volatility or cheap premiums, the market's expecting not that much movement. And Jason's going to show you the charts, and he'll show you the fact that we've seen so much volatility, and that will relate to the option premiums normally. And Jason will go into all that. That's about all I have, Jason.
Yeah, absolutely. And I will touch base on that. What Steve was mentioning essentially is the purchase of a call and a put at the same time. And the one key thing, although I don't have any slides to illustrate this in this particular presentation, but the one key thing you always have to remember, and this is regardless of which market you're trading, is that you have that price, that pair value, whatever it is, has to move significantly enough to offset the value of the position that you've created. And when options are priced accordingly to the volatility in the market, as Steve mentioned, right now, highly volatile market, options are more expensive. If you're paying a lot for a call and a put at the same time, you have to recognize that you really do need to see that pair value move significantly to help offset that. So something to keep in mind when you're looking to combine the two. Yes, you can, but the bottom line is that you need to trade through that theoretically before you actually apply your capital to that, to make sure that there is a probability of you making money. And that goes with using some of the great trade simulators that you have available. We have one available on our homepage. I know Options Express also has one where you can set up the parameters of the trade and look at where that position would be valued at according to where the actual underlying has gone, and you can see whether or not you would be profitable. And believe me, it's well worth the time and effort to spend a half an hour doing that than jump into an opportunity and then recognize that maybe you've paid too much and now you're trying to repair the situation. So on that note, I will move forward. The key here, folks, when you're looking to identify an opportunity in the FX options market, is that you want to simplify your approach. Create a checklist as you analyze a price chart. And this is essentially what we do on a day-to-day basis, whether we're analyzing the FX spot market, whether we're analyzing the futures market. Doesn't matter. We're still using this technical approach to identifying opportunities. We want to create a directional bias. We want to look at the clues that are being presented to us and then create a thesis as to where we think a particular underlying is going to go. And then from there, we want to look for clues, again, such as a pattern identification, which you guys can go back and review our last ISE FX options webinar, where we talk a little bit more about patterns. You want to look at your lower indicators, such as your MACD, your RSI, and you want to build that case. And then finally, and most importantly, in our opinion, is that price action signaling an entry? So realistically, it doesn't matter whether you've identified several bullish or bearish trading patterns or trading signals from your lower indicators. The true measure or validity of that is going to be observed in whether or not the price action actually breaks into those higher highs or down into those lower lows. So keep it real simple when you're starting, and that's not to say that you can't get more sophisticated, because certainly there's enough indicators and oscillators and different approaches to technical analysis that you can use. But a lot of times when you're first you're first starting out, it can be a little overwhelming. So keep it simple, create that checklist, and then build your case from there. Now, once you have that in place, the question becomes, well, how do we participate using these options, which is essentially why everybody's here tonight? Well, first of all, again, you want to keep it simple. There are a lot of sophisticated option strategies out there, and ultimately at some point, there's no question you may want to start to look into them to see whether or not they're suitable for your trading objectives. But when you're first starting out, one thing that we see a lot is that everybody wants to jump into those sophisticated, the caviar strategies of the options world, as we call it. And realistically, we want people to focus on the meat and potatoes right away. And what that does is it actually gives you a foundation to build on when it comes to then creating some of these more advanced positions in the market. So first and foremost, one of the simplest ways that you can participate once you've identified a directional bias is you could simply buy a call option or buy a put option on any one of these FX options pair values. Now, you can also very simply create what's referred to as a debit spread, which is going to help you lower the cost of the trade. So what we're going to focus on tonight is, again, just keeping it very simple. We're going to talk about buying a call or buying a put, depending on our directional bias. And we're also then going to talk about, well, how can we help lower the cost of those positions given the current state of market volatility and the expensive nature of options right now. So we'll move forward into that. What we want to do is create, obviously, a basic FX market outlook. And when we're using FX options, it's real simple. If we expect the U.S. dollar to strengthen against an underlying currency, we're going to buy calls. And just like in any other market, when we buy that call option, it gives us the right to buy or own that underlying security, in this case that underlying pair value, at a specific price. Now, we're not necessarily planning on taking control of shares per se, because obviously we're looking at an index, so it's used as a benchmark. But we know that if we buy the right to control, say, the AUX at 150, and the AUX moves up to 160, well, then we have now our right to own it at 150 has increased in value, and that profit can be taken and settled for the U.S. dollar equivalent. Okay, so hopefully everybody understands that concept. Okay, the opposite, the alternate way to participate is that if we expect the U.S. dollar to weaken, we can buy puts. And puts, quite simply, give us the right to sell at a specific price. And again, if we feel that the Australian or the U.S. dollar is going to weaken against the Australian dollar, then we can buy the right to sell that particular pair value at, say, 150. And as it drops to the lower levels, down into the 140 and 130 or what have you, the right for us to be able to sell it at 150 increases in value, and consequently we can then offset that position and have that settled for the U.S. dollar equivalent. Okay, so very, very simply, buy calls if you anticipate the U.S. dollar going up, buy puts if you anticipate the U.S. dollar going down, and then, of course, you need to select the appropriate pair value in which you're looking to trade this outlook.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.